what Live Oak's able to do differently, given that you guys do have the specialized division.
We're able to make cash flow based loan decisions, which I think is really unique compared to a local bank.
What's the biggest mistake that you're seeing these contractors make with debt right now?
Trust your gut and don't ignore red flags. Everything may seem really good on the surface, but then you start digging through and realize that there's a little bit of customer concentration risk.
So welcome to Ask Frank. We're in 15 minutes. We have an expert answer one of our audience members' questions. And today we're really lucky to have Dillon Caraway. So Dillon is a senior loan officer at Live Oak Bank. We've also interviewed one of his colleagues, Marie. However, Dillon specializes in services, particularly financing across the United States. So the man that funds, service contractors throughout the country. So welcome, Dillon.
Yeah. Thanks for having me on, William. It's a pleasure.
So today we've got a question from one of our audience members, and he writes in, he says, Frank, I run a $3 million HVAC business in Charlotte, been with my local bank 15 years. They know me, don't particularly know the industry. And I keep hearing that Live Oak, I keep hearing about them. I hear that, they really specialize in trades. So just really keen to understand, from your point of view, what's getting funded in 2026, what's getting walked away from, and, what should a contractor who's doing between 1 to 5 million be looking at for this year? A pretty long question. So maybe let's just take a step back. And what I'd love to understand is, what role do you play at Live Oak? Because I know it's separated up into a number of different facets.
Yeah. So you had a previous loan officer, Marie, on who did a fantastic job. She is on our general lending team. So she kind of, specifies in a region and lends to every industry.
Mm-hmm.
We also have industry specific teams that we call verticals, which we have like 40 plus. I work on what's called our service contractor verticals. So think primarily HVAC, plumbing, electrical, roofing, and garage door service companies. And I've been working in this specific industry since early 2020, been at the bank since 2017, but it gives us kind of the, under the hood look into these businesses to understand the value, what to look for, red flags. So primarily my job is to work with business owners on evaluating financials, structuring loans, kind of seeing them go from start to finish, and also building industry specific relationships with different industry partners, such as like manufacturers, distributors, coaching groups, fractionals, CFOs, accounting firms, things of that nature.
And I guess from your seat at Live Oak, what's actually happening in the trades, especially in the lending kind of area of 2026, what's deal flow, what's getting funded, what aren't you guys that excited about?
Yeah, there's a lot happening. So the trades industry is kind of like golf with like the COVID effect.
Yeah.
No one really played golf before COVID, and golf is like it's like impossible to get a tee time these days because everybody loves golf.
Yeah.
And we kind of saw that same trend with buyers, especially like private equity, really started focusing in on these types of businesses because they were deemed essential. They're kind of recession resilient, so they have stable reoccurring revenue. So we're seeing a lot of interest in the industry from large consolidators that are looking to buy up mom and pop businesses, but we also see a lot of existing contractors doing 1 to 10 million bucks in top line revenue, looking to go and purchase another business doing 1, to 10 million in revenue. And then we also see a lot of folks that are individual buyers that may not have direct industry experience, but have transferable industry experience that want to get into the industry. And those are deals we still love to do. Obviously, if they don't have that direct industry experience, there's a little bit more due diligence required to make sure that we do have the right operator running the business that's signing off on our loan. So we're seeing a lot of activity and acquisitions, whether that's, new to the industry or existing and in the industry already. We're seeing a lot of commercial real estate purchases. Folks are really looking to take advantage of owning their real estate versus leasing from, a landlord and building equity for somebody else. We're seeing a lot of working capital, so investing in the organic growth of your business, whether that's hiring, training, equipment purchases, marketing expenses, things of that nature.
I guess, what does that actually mean, right? So maybe let me take a step back. When you're starting to lend to a lot of these groups, as I understand, banks aren't lending on revenue, they're lending on cash flow, right? Mm-hmm. So what does this actually mean for a $1 to $3 million operator who wants to grow, but isn't particularly being seen by his bank? So it'd be great just to understand, the debt to service coverage and how you evaluate there and what someone can do.
Yeah. So a lot of banks and like local credit unions are really good at lending on a commercial real estate because they have collateral they can touch. They're making a loan to value based loan decision, and they've done that for 100 years. But when a contractor comes in and says, "Hey, I want to buy my local competitor," they're like, "Okay, well, what collateral can you pledge to fully secure the loan?" And they're like, "Well, there's not tangible collateral, but there's goodwill in the business. There's really good reputation that's been around for 40 years. There's stable recurring cash flow." And that bank's like, "Yeah, that's not really what we specialize in. Sorry, we're not able to help." So that can leave the business owner in a tight spot. And with Live Oak specializing in the trades, we understand the value of these businesses. We understand what to look for. We really love the service repair, like replacement or retrofit type business model for residential commercial businesses. So we understand that, that business owner is going out and really like building and working with what we call sticky customers, which means, that business is typically going out and servicing their unit once or twice a year. They're staying top of mind. So when that homeowner has an issue with their water heater or their HVAC system, or they need their roof replaced, they already know who to call before even going on Google or anything like that.
One element that I did want to talk about that you raised before was the real estate play, right? So you're saying a lot of trade operators are buying their own buildings. When's the math actually make sense for them? And, from your point of view, when's it not making sense? And the reason, again, kind of asking that is I think it's pretty tempting for a lot of people to want to try and buy, right, their own building.
Yeah, I think that's a great question. I always am a fan of owning real estate. I think real estate typically appreciates. There's tax advantages too with interest and depreciation write-offs. But where I think it could potentially not make sense is if like you just have a really awesome lease agreement that just kind of been in place for 10 or 20 years and your landlord's never increased your rent. So you're paying way under market, averages. And you go to look to purchase a building and you're looking at what a mortgage payment would be versus your historical lease payment would be, and it's like double or triple. While that's still maybe a move in the long run, you do have to kind of evaluate how that will impact your monthly cash flow, because if your rent expense is going to be replaced by a mortgage payment, and that's essentially going to double or triple, that eats into the available cash flow of your business. You also got to think about being able to get the building insured, what our property tax is going to be. So there's a few different things that go into it, but owning real estate, you have control over your building. So you're not at the mercy of being in the middle of busy season and your landlord selling the building and having to figure out somewhere to go in 90 days. Often allows you, opportunity to grow your business. So we're really big fans of owning commercial real estate.
And so if we come back to the question that we had from one of the audience, not being seen by their bank, they've been with them for 10, 15 years, I guess it'd be great to understand what Live Oak's able to do differently, given that you guys do have the specialized division.
Yeah, so we're able to make cash flow based loan decisions, which I think is really unique compared to a local bank. So we do not have to have collateral to fully secure our loan to get approved through the SBA loan program. We're a preferred lender with the SBA loan program, so we get to approve decision and fund loans in-house, so we don't have to go to them for approval with every application. So that really expedites the loan process by about 60 to 90 days from what it could be if you went through general processing. So generally speaking, from start to finish for one of our acquisition or real estate loans, it's probably going to be roughly 6 to 8 weeks, and that's from full application in hand to funds going out the door. So we can move pretty quick compared to what some folks may hear of like horror stories with SBA loans. But I think like the biggest benefit of working with the bank that understands your business model and your industry is we're not there just to do the first deal. We're there to help do the second, third, fourth deal. If that business owner's goal is to get from 1 to 20 million, it's kind of hard to bootstrap that. So, it's good to work with the bank that truly understands the industry, but also understands the risk associated with that type of growth. So we don't want to over leverage folks to where, we're looking at just strictly projection based deals where it may be trouble for them to pay the loan back. So while we, do want to help them reach their goals, we kind of look at it as an approach of, there's a real person on the other side of this loan decision that we're making. So if we make a loan decision that goes bad, that's not good for the bank, it's not good for the business owner, and nobody wins. So we want to make sure we're setting that business owner up for success while also, giving them the opportunity to reach their growth goals.
I think, you touched on a point there, which is, the person on the other side. What's the biggest mistake that you're seeing these contractors make with debt right now? And I guess, what are you trying to advise them before they sign, or what are you trying to kind of steer them away from at the moment?
Yes, mostly so in acquisitions, and a lot of it's really hard to kind of uncover prior to funding the business. But, I think like my best advice is trust your gut and don't ignore red flags. So there may be a local business that comes up for sale and it's, a really good purchase price multiple compared to earnings. Everything may seem really good on the surface, but then you start digging through and realize that there's a little bit of customer concentration risk, or they might do more types of work that are project based versus, reoccurring with higher margins. And, I think one thing that's really important to kind of do due diligence on is looking at their employee turnover. How long have their employees been with them? I think that kind of speaks volume. If they have folks that have been with them for a while, if all of their employees have been there within the last 6 months or started within the last 6 months, then that may lean to be a culture problem within that business, which is hard to fix under new ownership, in the early stages. So it sounds simple, but really trusting your gut is going to help, save a lot of heartbreak.
You kind of mentioned in that acquisition channel, I imagine that there's a lot of kind of contractors out there who are, in fact, I see them in forums they're working for somebody else. Maybe they don't have as much money as they need to go out on their own. They're looking at, maybe they've been given a chance to acquire, their boss's business or buy part of it. What do they need to bring to the table in order to buy out one of these businesses? And I think it'd also be good to understand, like, what is it that people aren't telling them, right, in regards to these acquisitions?
Yeah, so a few things we look at is, if they're wanting to buy the business that they're currently working for, they check the box for industry experience.
Yeah.
Another thing that we look for is licensing. So making sure that they can license the business post-close. Through the SBA loan program, it's hard to license the business under the seller's license unless they retain equity post-close. So going ahead and working towards getting your license or certifications that you need to operate the business and generate revenue and remain compliant. Having a personal credit score of 680 and above is really important in managing personal debt responsibly. Because if you're spending more money than you make on a personal level, then that's probably not going to translate well into running a business. So just making sure you're being responsible with your personal finances. And then outside of that, the SBA requires an equity injection of roughly 10% of total project costs for first-time buyers. And that's typically what we look for in first-time buyers. If there's a GM that's been in the business for 10 years, there may be a way to split that up between 5% cash and 5% seller financing. But we reserve that type of structure for very strong internal buyouts when we consider that GM or that key employee or that family member to have sweat equity in the business. So generally speaking, we're looking for 10% of cash to come from the buyer or a person that's personally guaranteeing our debt.
I guess, you've got visibility across the whole US, right? What's happening in services in terms of like lending and acquisitions. Are there any areas where you're seeing a lot more concentration in terms of excitement, like, might be Texas or Florida, or, the kind of areas that over the last couple of years saw a boom and aren't seeing as much now? Like, what kind of patterns are you seeing around the country?
Yeah, I think, your Florida, your Texas, your Arizona, your California, just population and climate are always going to be hotspots for like heating and air companies. The Northeast I think in the past few years, they've had like energy incentives or rebate programs that have been beneficial to HVAC companies. But it's kind of hard to like really pinpoint like a specific area that's just been like, a hot spot. I mean, I've visited a customer all the way in Alaska from North Carolina where we financed an internal buyout. So, I mean, they're all over the place.
Where are you seeing the single biggest opportunity in the trades lending, over the next kind of 12 and 24 months that operators should know about?
I think it's changes of ownership. If you look at the average age of a business owner in the trades industry, it's probably between 55 and 65.
Yeah.
And nobody wants to work forever. I mean, most folks do want to retire or reduce their work capacity in some level. So whether that's, acquisitions, internal buyouts, I think that's going to continue to be a theme over the next 5-10 years, because a lot of these business owners are going to want to, pass the torch. And, that's hopefully where we'll be able to help, with a lot of those opportunities.
Well, Dillon, this has been really amazing. So thank you so much for joining us.